On Friday, U.S. stocks saw Broadcom plunge 11% in a single day, dragging the entire AI trade sharply lower. For many people, the first reaction was simple: is something wrong with AI? But let me put the conclusion up front. The problem is not AI. The problem is the trading line you're standing on right now. Because on that same day, the Federal Reserve was not hawkish at all. The Dow Jones even rose for the third consecutive week. Capital did not leave the market. This was not a panic-driven sell-off, but a highly selective one. Some positions were cut with precision, while others were quietly absorbed on the other side. So what really matters is not how much prices fell, but whether you've realized one critical fact. Wall Street money has started to discriminate. If you simply treat this drop as a normal pullback, you may be underestimating its significance. What's truly unusual is not the magnitude of the decline, but the fact that the market's reaction to good news has completely changed. Over the past 2 years, whenever AI companies delivered earnings above expectations, their stock prices were almost always rewarded. This time, the better the earnings, the more aggressive the selling. That alone is a very dangerous signal. It tells us that the market's focus has quietly shifted from "is there growth?" to "is it worth this price?" When all good news fails to push stock prices higher, only one thing remains: repricing. And repricing is never completed in a single candlestick. It usually means a prolonged period of volatility and divergence. More importantly, this shift is not emotional. It is highly rational. Capital is not fleeing. It is simply demanding much stricter standards for different assets and different stories. So what exactly is the market repricing? The answer is hidden in Broadcom's earnings report. On the surface, the numbers are nearly flawless. Revenue beat expectations, AI chip revenue continued to grow rapidly, AI order backlog for the next 6 quarters reached $73 billion, and multiple Wall Street banks raised their price targets. Over the past 2 years, results like this would have been a clear signal to add more. But that's precisely the problem. The market already knew all of this and had already priced it in. When everyone assumes AI will keep growing at high speed, orders will keep being revised upward, and customers will keep increasing, earnings themselves stop being the key driver of stock prices. What really matters becomes a more subtle question. Can this growth maintain the same quality of profits as before? This time, Broadcom was very clear. AI orders are indeed large, but a significant portion comes from more customized, longer cycle, lower margin system level orders. In other words, AI revenue is still expanding, but the quality of profitability is becoming less uniform. This may not be a bad thing for the company's long-term strategy, but for a trade that has become extremely crowded, it is more than enough reason to reduce exposure. So what you're seeing is not the market rejecting Broadcom's AI capabilities, but capital seriously separating two questions for the first time. Can AI sell more, and can AI keep making money the way it used to? Once that question is openly raised, even uncertainty alone is enough to trigger repricing. Looking back, you'll realize Broadcom was simply the first company to be hit, not the only one. The reason is simple. It sat at the very top of the AI trade, with the highest expectations and the strongest consensus. When the market begins to doubt whether this trade can continue delivering higher returns, the first cut always lands where positioning is most crowded. That's why Broadcom's drop wasn't immediately bought. This time, capital wasn't asking, has it fallen enough, but rather, is this entire logic still worth such heavy positioning? More importantly, this shift is not unique to Broadcom. Over the past 2 years, The AI rally followed a very clear playbook: unlimited demand, endless orders, scale first, valuation later. But now that order scale has been validated, the market naturally moves to the next stage, scrutinizing costs, margins, capital expenditures, and sustainability. As a result, you're seeing a very typical phenomenon. Good companies remain good companies, and the long-term story remains intact. But stock prices no longer move smoothly. That's because the market is separating long-term belief from mid-term trading. At this point, you no longer need to ask whether AI is still valid. The real question is, when the trading line shifts, which layer are you standing on? Based on recent market behavior, I break current U.S. equity opportunities into three categories. First category, still on the AI main line, but not yet targeted. This sell-off was not indiscriminate. The hardest hit names were always those with the highest positioning and strongest consensus. Some AI assets haven't been prioritized yet, but remember, not being sold does not mean being safe. It simply means they're not first in line. Their common trait is simple. The way they make money hasn't made capital uncomfortable yet. But keep this in mind. This is where capital hasn't acted yet, not where it has decided to stay forever. Second category, areas that have started to outperform AI. This is where money is quietly reallocating. Not explosive moves, but steadier relative strength. Clear cash flows, reasonable valuations, low sensitivity to rates, and no need to burn capital endlessly to tell a story. Not exciting, but holdable. Third category, the cheapest looking traps. Big drops, high beta, stories still sound alive, but heavily dependent on financing, sentiment, or the next bigger narrative to take over. The real risk isn't another crash, but being slowly worn down by repeated choppy moves. By now, you should feel it. This is not a market you can act on immediately after listening once. The hardest part isn't understanding the direction. It's avoiding standing on the wrong side when the trading line changes. A plain English takeaway for everyday Americans: this AI adjustment is not the end of the world, nor is it the collapse of technology. It's Wall Street shifting from chasing stories with eyes closed to doing the math with eyes open. For ordinary investors like us, it signals a transition. In the next phase, money won't be made by betting on the hottest narrative, but by standing where capital is actually willing to stay. Our channel is to focus on important financial events in the world, get high investment returns, and release 2 to 3 videos every week. See you in the next issue.